If you were audited tomorrow, would your paperwork protect you? You can set up the right entity structure and all the things that we've talked about in the last couple of videos. But if your record keeping is weak, all of that structure starts to weaken too. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to zero taxes by using real estate tax strategies. Today, I want to talk about something that doesn't get nearly enough attention, and this coming from a CPA, and that's proper record keeping. And I don't just mean keep your receipts in a folder. I mean running a properly operated business with clean books, organized documentation, and systems that would actually hold up under scrutiny. Because if you ever get audited, the IRS could dig deeper into your books. And if you don't have any books, they will look at all of your bank accounts. And if you ever end up in a legal situation, courts look at how you operated, not how you intended to operate. So let's talk about what this really looks like. First, you need consistent, clean bookkeeping, not once a year at tax time, and not I'll clean it up before I send it to my CPA. At a minimum, that means reconciling bank accounts, reconciling credit cards, categorizing income and expenses correctly, reviewing your profit and loss, and your balance sheet. Let me give you a simple example. I've seen business owners who thought they were profitable because there was money in the bank. But when we cleaned up the books, we realized they hadn't accounted for payroll liabilities, they hadn't accounted for sales tax owed, and they hadn't accounted for credit card balances. They weren't nearly as profitable as they thought. The bookkeeping isn't just about taxes. It's about knowing the truth about your business. And from an audit standpoint, when the books are reconciled monthly, it signals organization and discipline. Now, I want to talk about proper documentation of deductions. Now, we all want to take legitimate deductions, but every deduction has to be defensible. That means receipts for large deductions, business purpose documented for meals and travel, mileage logs, clear home office calculations, or an accountable plan for an S Corp, and separating out repairs from improvements. Here's a real-world situation I see often. Someone deducts a large travel expense because they looked at investment property, but there is no record of who they met with, what properties they evaluated, were any offers made, and what was the business purpose. If the IRS asks for documentation and all you have is a credit card statement showing airfare, well, that's weak support. But if you have notes from meetings, emails with agents, property listings, or a documented schedule, now it all becomes more defensible. And the strategy might be solid, but documentation is what protects it. Now, on a side note, I've been in an audit for someone, and they had airfare and travel expenses on their tax return. And this person was traveling for events, and they verified those events by looking up the schedule, and they were able to tie those together. And that worked out pretty well for that client. But do not rely on that yourself. So third, organized business paperwork. This goes beyond bookkeeping. A properly run business maintains organized records of operating agreements, amendments, resolutions, lease agreements between entities, loan documents, insurance policies, and payroll filings. Now, here's where this becomes real. Imagine you have an operating company leasing property from your holding LLC. If there's no written lease agreement, just money moving between accounts, and something happens legally, that separation becomes harder to defend. Or let's say you bring on a partner. If ownership percentages are never formally documented, then that creates confusion and potential disputes down the road. Organization prevents future problems. You don't want to recreate history under pressure. Now, here's a very important one: clear handling of owner transactions. This is one of the biggest problem areas. Money moves between the owner and the business, but it's not labeled correctly. I've seen situations where owners call everything a distribution, but they didn't have basis, or it was actually repayment of a loan, or it should have been payroll. And that miscalculation creates tax consequences later. Another example: an owner puts $75,000 into their business, but never documents whether it's a loan or capital contribution. A few years later, they take that money out. Now we have to untangle, was it a repayment? Was it taxable? Does it affect basis? When transactions aren't documented at the time they happen, they become expensive to clean up later. Clear classification prevents future tax surprises. Now let's talk about systems. Systems that support the structure of your business. If you're serious about running a business, you need systems. That usually means accounting software, payroll software, digital receipt storage, if not physical receipt storage, organized cloud folders potentially, and a monthly review process. I've worked with clients who've tried to run everything off of bank statements and memory. At tax time, they're sorting through thousands of transactions trying to remember what that something was. And that is stressful, and it increases the risk of mistakes. When systems are in place, you're not scrambling at year end. You're making decisions throughout the year based on real data. And again, when I meet with my clients, we need that real up-to-date data in order to plan for taxes for the year. So here's another thing that I run into regularly. We have clients that start out as a small business and they grow. And as they grow, there are more requirements when filing a tax return. For instance, if you make over $250,000 in revenue, or you have over $250,000 in assets, you have to file a balance sheet on your tax return. One of the things that we have issues with is trying to figure out what that beginning balance was for last year in order to get everything to balance out on the books and on the tax return. So if you're not keeping accurate records and you're not using software that enables that, that can cause problems. One thing I will say is if you're using QuickBooks Self-Employed, there's two issues that I've run into with that, not overcomable, but it is an issue. First of all, self-employed QuickBooks subscription does not include a balance sheet, so you don't have beginning balances there. Another thing that I found out a few times with clients is if they want to upgrade from QuickBooks Self-Employed to the next level of subscription, all of that data in that self-employed version goes away. It does not convert over and upgrade to that next level. So something to keep in mind, QuickBooks Self-Employed is good for the right person, but we need to talk about what your plans are to grow and make sure we can carry over that information into the future. Now, if you need help figuring out which accounting software or subscription level is best for you, then there's a link below to a survey that will help you figure that out. Now, for real estate owners, if you own rental properties, clean records are even more important. For example, if you replace a roof, that's likely a capital improvement. It goes on your assets and gets depreciated. If you patch a leak, then that's a repair and it's expensed right away. We have to know the difference. Sometimes those are fairly obvious, but sometimes they're not. If those are mixed together and expensed incorrectly, it can distort your tax return. One important note that I will say that I've seen multiple times as well is people try to do bookkeeping for a rental and real estate investment company, and they don't even book the closing statements. Those closing statements include the cost of the house plus other costs of purchasing, realtor fees, closing costs. It's got your loan balance in the beginning and other information that's important because that has to also go on your tax return. But it also should be in your books because that's going to show your net equity, which is your assets, which is your houses, minus your liability, for instance, your loans, and that gives you your equity as part of the calculation. So the other thing is if you're claiming material participation in order to take advantage of some of these tax strategies we talked about, but you have no log showing the time you spent, then that deduction becomes very vulnerable with the IRS. A real estate strategy is very powerful, but it only works when you have the documentation to support it. So to summarize, entity structure gives you the framework. Liability protection gives you the separation, but record keeping makes everything defensible. Without clean records, good strategies may look aggressive, solid structures look informal, and protection becomes fragile. With clean records, your numbers are clear, your strategy is supportable, and your business looks legitimate and organized. And it helps you plan for your tax liability better. And all that matters legally and financially. Now, if you've set up your entities, but you're not confident your books and documentation would hold up under scrutiny, that's the next level of business ownership. Protection isn't created when you file the LLC paperwork. It's created in the way you operate every single month. When you reconcile, when you document, when you classify transactions correctly, that's what separates someone who has an entity from someone who runs a properly structured business. If you found this helpful, check out our other videos, like the video, and subscribe to our channel.